Hey there, investment enthusiasts. Iggy here from the Investing Iguana YouTube channel. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 370,000 reads. In this video, we're going to dive deep into the reasons why DBS has given ComfortDelGro a resounding buy rating with a target price of $1.80. But before we get into the nitty-gritty details, let me ask you a question. Have you ever wondered what goes into a bank's decision to rate a company as a buy? Well, buckle up, because we're about to unravel the mystery behind this coveted rating. When a bank like DBS gives a company like ComfortDelGro a buy rating, it means their analysts have thoroughly evaluated the company's financials, business prospects, and overall potential for growth and profitability. This rating essentially serves as a strong recommendation for investors to consider purchasing shares of the company. In ComfortDelGro's case, DBS has set an ambitious target price of $1.80 per share, which is significantly higher than the current trading price. This target price is based on a comprehensive analysis of various factors, including the company's historical performance, industry trends, competitive landscape, and future growth strategies. Based on the DBS research report, there are 3 key reasons why DBS has reiterated a buy rating on ComfortDelGro with a higher target price of $1.80. Multiple growth levers in Singapore's growing point-to-point (P2P) market. Firstly, DBS analysts see multiple growth opportunities for ComfortDelGro in Singapore's rapidly expanding point-to-point (P2P) transportation market. This market includes both traditional taxis and private hire car services like Grab and Gojek. ComfortDelGro has been proactively adapting to this changing landscape by shifting towards a commission-based business model for its taxi fleet. This means that instead of relying solely on rental income from taxi drivers, the company now earns a percentage of the fares generated by its taxis. This strategic move opens up several potential upsides for ComfortDelGro. For instance, if taxi fares increase due to factors like higher demand or fuel costs, the company's commission revenue will also rise proportionately. Additionally, if the number of rides taken by ComfortDelGro's taxis increases, either through street-hailing or ride-hailing platforms like Grab, the company's earnings will get a boost. Moreover, DBS analysts believe that the proportion of rides booked through ride-hailing apps will continue to grow, and since these typically command higher fares than street-hailed rides, ComfortDelGro stands to benefit from this trend. Another factor working in ComfortDelGro's favor is the recent regulatory changes implemented by the Singapore government. These measures aim to level the playing field between traditional taxis and private hire car services, ensuring fair competition and potentially increasing the demand for ComfortDelGro's taxi services. Firstly, DBS analysts see multiple growth opportunities for ComfortDelGro in Singapore's rapidly expanding point-to-point (P2P) transportation market. This market includes both traditional taxis and private hire car services like Grab and Gojek. ComfortDelGro has been proactively adapting to this changing landscape by shifting towards a commission-based business model for its taxi fleet. This means that instead of relying solely on rental income from taxi drivers, the company now earns a percentage of the fares generated by its taxis. This strategic move opens up several potential upsides for ComfortDelGro. For instance, if taxi fares increase due to factors like higher demand or fuel costs, the company's commission revenue will also rise proportionately. Additionally, if the number of rides taken by ComfortDelGro's taxis increases, either through street-hailing or ride-hailing platforms like Grab, the company's earnings will get a boost. Moreover, DBS analysts believe that the proportion of rides booked through ride-hailing apps will continue to grow, and since these typically command higher fares than street-hailed rides, ComfortDelGro stands to benefit from this trend. Another factor working in ComfortDelGro's favor is the recent regulatory changes implemented by the Singapore government. These measures aim to level the playing field between traditional taxis and private hire car services, ensuring fair competition and potentially increasing the demand for ComfortDelGro's taxi services. According to DBS analysts, the worst seems to be over for ComfortDelGro's public transport business, which includes bus and rail operations in various markets. The analysts believe that this segment will experience continued profit growth in the financial year 2024, FY24, driven by a combination of factors. One of the key contributors to this expected improvement is the anticipated turnaround in ComfortDelGro's operations in the United Kingdom. The company's UK business, which primarily consists of bus services, has faced challenges in recent years due to factors such as driver shortages and rising costs. However, DBS analysts believe that these issues are being addressed, and the UK operations are poised for a recovery in FY24. In Singapore, where ComfortDelGro operates both bus and rail services, the analysts expect higher rail fares to offset any potential decline in bus contributions. Rail fares in Singapore are typically reviewed and adjusted periodically to account for factors like inflation and operational costs. An increase in rail fares would directly translate into higher revenue for ComfortDelGro's rail operations, helping to offset any potential weakness in the bus segment. It's worth noting that the bus business in Singapore has faced headwinds in recent years due to factors such as competition from private hire car services and changing commuter preferences. However, DBS analysts believe that these challenges are likely to be mitigated by the company's efforts to optimize its bus routes and services, as well as the potential benefits from the aforementioned regulatory changes aimed at leveling the playing field between taxis and private hire cars. So, what is the strategic deal that ComfortDelGro is involved in that DBS believes will enhance its prospects of securing additional rail contracts? Based on the DBS research report, one of the key strategic deals that DBS believes will enhance ComfortDelGro's prospects of securing additional rail contracts is the joint venture with Go Ahead Group to operate and maintain the Stockholm metro system. Specifically, the report highlights that ComfortDelGro's joint venture with Go Ahead Group, called Connecting Stockholm, was awarded an 11-year contract worth over 5.1 billion Singapore dollars to run and maintain the 3 existing metro lines in Stockholm from May 2025 onwards. The report states that this is ComfortDelGro's first rail contract in Sweden and will be its largest rail passenger operation outside of Singapore. It notes a few key points about this strategic deal. It expands ComfortDelGro's international rail footprint significantly, bringing the total length of rail it operates to 317 kilometers. Go Ahead Group, ComfortDelGro's partner, has extensive experience in rail operations in markets like Norway and the UK, which complements ComfortDelGro's capabilities. The large scale of the Stockholm metro system and the opportunity to support future expansion plans provides ComfortDelGro exposure to develop rail expertise that can aid in securing additional contracts globally. Winning this major contract against competition from incumbent operators like MTR and SMRT demonstrates ComfortDelGro's competitiveness in bidding for international rail projects. Overall, DBS views this strategic joint venture deal to operate the Stockholm Metro as a significant milestone that enhances ComfortDelGro's credentials and positions it well to pursue other rail opportunities internationally going forward. Based on their comprehensive analysis of ComfortDelGro's various growth drivers, DBS analysts have raised their earnings forecasts for the company for the financial years 2024, FY24, and 2025, FY25, by a significant 6 to 9%. This upward revision in earnings projections reflects DBS's confidence in ComfortDelGro's ability to capitalize on the multiple growth opportunities available to it. Furthermore, DBS has set a higher target price of $1.80 for ComfortDelGro's shares, reflecting their expectation of over 20% earnings growth for the company as it enters FY24. This target price represents a significant upside from the current trading levels, making ComfortDelGro an attractive investment opportunity for those seeking exposure to the transportation and logistics sectors. It's important to note that while DBS's analysis and projections are based on thorough research and sound assumptions, there are always inherent risks and uncertainties associated with any investment. Factors such as changes in market conditions, regulatory environments, and consumer preferences can impact a company's performance and future prospects. There you have it, folks, a comprehensive breakdown of why DBS has rated ComfortDelGro as a buy with a target price of $1.80. From multiple growth levers in Singapore's thriving point-to-point market to the recovery of the public transport segment and strategic bolt-on acquisitions, ComfortDelGro seems poised for success. Now, it's your turn to weigh in. Do you agree with DBS's assessment? Are you considering adding ComfortDelGro to your investment portfolio? Let me know your thoughts in the comments below. And don't forget to like this video and subscribe to the Investing Iguana YouTube channel for more insightful analysis and investment tips. Together, we can navigate the ever-changing financial landscape and make informed decisions that propel our investment journeys forward. Until next time, happy investing.